What is KYC? How crypto exchanges prevent money laundering. KYC, the acronym for Know Your Customer, is a process that businesses and financial institutions are required by law to follow to prevent money laundering. The principle of KYC requires users of services who wish to deposit or withdraw funds from crypto exchanges to verify their identity. In recent times, Know Your Customer, KYC, and blockchain technology have become two concepts that are frequently employed together. As a result of the anonymity it provides, blockchain technology has experienced fast global proliferation, yet, it now faces the challenge of complying with applicable financial regulations. Although it has not yet achieved widespread adoption, the use of blockchain technology has been growing throughout the past few years. To preserve their capital in the form of cryptocurrencies and other digital assets, investors are lured to the decentralized structure of blockchain technology. Since central banks do not issue cryptocurrencies, investors enjoy increased levels of privacy. On the other hand, because of this anonymity, it is much simpler for criminals to launder stolen money and use it. As a consequence of this, the protection of the data held by Bitcoin users is currently more vital than it has ever been. You have now reached the point when you are exposed to the combination of KYC and blockchain. What does KYC stand for? As part of the Know Your Customer procedure, which is the foundation of AML/CFT compliance standards all over the world, financial institutions are required to identify their customers and make an effort to know the nature of the business in which they are engaged. When clients employ a specific organization's services, the standard Know Your Customer, KYC, approach involves continual screening and monitoring, in addition to several steps involving due diligence. As a consequence of this, providers of financial services are better able to identify customers who are abusing their products and services and to put a stop to illegal activities like the laundering of money and the funding of terrorist organizations by developing comprehensive and accurate customer risk profiles. In addition, knowing your customer procedures are essential in economic contexts since criminals employ a wide array of strategies to circumvent anti-money laundering and counterterrorism financing regulations. The Know Your Customer, KYC, process may present a more difficult compliance issue for cryptocurrency exchanges due to the increased effort that businesses need to put in to verify the identities of the customers who use their digital services and understand the particulars of the transactions that they are facilitating. How KYC contributes to preventing money laundering. When individuals open an account at a financial institution or make a purchase using the account, they must present documents proving their identity and the origin of the money. The procedure is called Know Your Customer, KYC. This policy helps financial institutions to identify and reduce risks associated with illegal activities such as money laundering, terrorist financing, and tax evasion. In many countries of the world, banks are required to follow KYC standards and even report to the Financial Intelligence Unit, FIU, when they detect suspicious financial transactions. KYC is a process involving customer verification and identification, which is performed to prevent money laundering. It involves processes such as customer due diligence, CDD, customer risk assessment, CRA, and customer acceptance policy, CAP. CDD is a procedure of identifying the customer's identity and verifying it with one or more independent reliable sources. CRA is a process of evaluating the customer's capability to maintain its financial obligations in the future and planning for unforeseeable scenarios. CRA and CDD are performed in parallel during the KYC process. Both procedures present checks to determine whether or not a customer fulfills the criteria for opening an account with a financial institution. These tests can be used by financial institutions to identify customers who may engage in or be engaged in criminal activities. Why is KYC important? KYC verification is important to prevent money laundering. It helps financial institutions to identify and reduce risks associated with illegal activities such as money laundering, terrorist financing, tax evasion, and other forms of criminal activity. Additionally, it helps prevent financial institutions from becoming the target of such illegal activities. The KYC process can also be used to detect customers who engage in or are engaged in criminal activity and to put a stop to such behavior. It can also help to prevent criminals from abusing the services of a financial institution. The KYC process is comprised of two phases: customer due diligence, CDD, and customer risk assessment, CRA. Each phase requires financial institutions to collect, update, and analyze related information. The information collected during the process is stored in a central database with complete confidentiality. Because the United States Financial Crimes Enforcement Network, FinCEN, and other international monetary officials, such as the Financial Action Task Force, have made it a requirement, financial institutions are now required to incorporate Know Your Customer, KYC, procedures into their respective systems, FATF. The Know Your Customer requirements for the regulatory bodies include monitoring the transactions of clients and reporting any behavior that seems suspicious. In addition to the Know Your Customer, KYC, verification process, financial institutions are required to use anti-money laundering, AML, procedures while conducting background checks on customers. However, due to the anonymity provided by Bitcoin transactions, those who commit financial fraud can get away with their illicit activities. Even though the decentralized nature of blockchain technology provides legitimate cryptocurrency investors with the privacy they require, the KYC verification process still requires the disclosure of personal information so that Bitcoin businesses can safeguard their interests. Additionally, the vast majority of Bitcoin transactions are currently excluded from the Know Your Customer, KYC, and anti-money laundering, AML, legislation. Although the cryptocurrency business is growing at a reasonable rate, there is currently a lack of legislation and regulations, which may impede its progress. How KYC and blockchain can be used together. KYC procedures can be put to good use in conjunction with blockchain technology. They can be used to provide access to professional cryptocurrency exchanges for legitimate investors and prevent money laundering by criminals. In this way, the risks associated with the activities of potential clients can be reduced. The decentralized nature of blockchain technology adds another layer of protection against money laundering, as financial institutions would not have complete control over transactions that are carried out on a blockchain. KYC verification can be integrated with the blockchain to provide the user with a greater level of security and privacy, while still allowing the user to transact with financial institutions. The process of verification is performed through the use of a pseudonym and a unique code that is generated from it. The pseudonym is maintained by the customer, who can always change it in case it is shared with others. Furthermore, for this functionality to work successfully, all transactions on the blockchain should be personally verified by users. KYC and Web3. For the KYC process to be implemented successfully, important decisions must be made on how cryptocurrency can be used and regulated in the back end. Some solutions that have been proposed can handle KYC verification while also maintaining the confidentiality of financial transactions. For example, an Ethereum smart contract could help with verifying user identities. Another solution would be another combination of the Ethereum blockchain and Web3 in which users can connect their bank accounts to their wallets. These solutions could be implemented separately, or in the case of a combination, implemented together and then gradually phased out in favor of another. The user account would be verified by connecting it to the bank account. For example, for verification through a smart contract, the status of the account would remain pending as long as it was not processed by the bank. This process would ensure security and confidentiality on both ends. Once approved by both parties, KYC verification can begin. After the identity of a user has been verified by his or her bank, the status of their account will automatically change to verified and they would then be able to transact on the exchange. In another example, for verification by connecting a bank account directly to the wallet, 3 alternative methods may be used. Firstly, when a user registers with an exchange platform that requires KYC verification for transactions, he or she can link their bank account with their wallet. Benefits of crypto KYC. Reduced legal risk. The KYC process is a long and tedious process that requires a certain level of expertise. Several important issues must be considered to make the process as efficient as possible. Some features, such as blockchain-based solutions, aim to simplify the procedure by eliminating the time and effort of data collection and verification. These features can be integrated into existing payment procedures or even with new ones. Increased customer trust. The KYC verification process ensures that customers have a level of trust in the company. A business credibility is severely damaged when it does not put users' interests first. Many businesses are already beginning to use blockchain technology for KYC to regain their credibility and attract new clients. Enhanced customer experience. The KYC process enhances the customer experience by making the transaction process easier and faster. This is especially true in cross-border transactions, as the information is processed quickly among different countries, for example, between Europe and Asia. Increased market stability. KYC verification can improve market stability because it increases trust between the buyer and seller. It also reduces uncertainty about the identity of a customer, which can encourage new participants to join and contribute to the growth of the market. Reduced risk of scams. Blockchain technology can make it easier for regular people to invest in cryptocurrencies. The KYC process is a way to ensure that these people are not just trying to obtain access to the markets but have real interests and expertise. With the current technologies available, KYC verification is still a challenging issue. Currently, there are a few alternatives that can be implemented into the Bitcoin and Ethereum platforms that would allow users to get verified without having the information collected by the exchange. Is KYC safe in crypto? KYC is the process through which a business entity can be verified, and it provides the customer, or investor, with various services such as banking, financial services, and credit. In cryptospace, KYC is an important process that companies must perform to avoid fraud by their customers. Therefore, they are struggling with KYC, how to implement it safely without compromising privacy. One of the main issues that crypto KYC is facing today is not having access to it on a global basis. Currently, companies are unable to perform KYC digitally and would have to physically collect hard copies. This can be distressing not only for customers but also for companies who are required to submit all records or information in an electronic format. The majority of businesses work with physical storage to hold documents. This can be tedious and inefficient as it requires a certain level of expertise in the system to manipulate the data for it to be transferred into an electronic format, which is then stored on a cloud server, often on a paper medium. Conclusion. KYC is a process through which a new business entity is verified, and it provides the customer with various services such as banking, financial services, and credit. So when we talk about KYC in the context of cryptocurrency, we are talking about KYC in general. Different types of compliance solutions offer a blockchain solution, but all of them have some sort of flaws that can be avoided by using the right combination of technologies.